Hello everyone, and welcome back to the Quant Lab. In our last session, we constructed the vertical thickness of our dense trading zones. We learned how to move our boundaries lines inward from the extreme wicks to capture the dense overlap of the K-line real bodies. But the vertical thickness alone is not enough. The market is constantly printing micro fluctuations and algorithmic noise. Today, we need to horizontally validate the zones across time. We must mathematically prove that a level is actually a macro baseline actively defined by institutions and not just a random cluster of candles. Let's start with a massive flaw in retail technical analysis. Beginner traders frequently draw a support line by connecting just two isolated swing lows on a chart. In quantitative geometry, this is useless. Because 2 points mathematically define a line, it is always possible to draw a perfectly straight horizontal line between any two random swing points on a chart. Therefore, a boundary based on only two touches carries two statistical weight. It is merely a hypothesis. To mathematically validate a support or resistance zone, we use the horizontal three-touch rule. Touch 1 is the origin, touch 2 establishes the horizontal alignment, but touch 3 is the confirmation. Only when the price comes back a third time, separated by time, and successfully defends that exact boundary, is the zone officially validated for execution. In the real world, horizontal support and resistance are rarely exact to the penny. High-frequency algorithms constantly probe boundaries, hunting for stop losses. This means the extreme wicks of or three touches will naturally fluctuate. If we demand absolute perfection, we will never find a trade. Instead, we apply a tolerance band. For standard large cap equities, the institutional standard is the 1% maximum deviation rule. We take the cluster of macro swing wicks testing our zone. We find the absolute highest wick, W max, and the absolute lowest wick, W min. We subtract the minimum from the maximum and divide by the minimum. If that percentage difference is less than or equal to 1%, the zone is mathematically validated. And you don't need a calculator to do this. In modern platforms like TradingView, you simply grab the price range tool, click your lowest wick, draw it vertically to your highest wick. And if the box reaches 1% or less, your structural boundary is confirmed. Let's look at a real example. Okay, let's look at this beautiful daily chart of Intuit to see exactly how we use this to filter out algorithmic noise. Look at this middle zone. We have a cluster of 7 local highs attempting to form a resistance ceiling. So if we count, we have 1, 2, 3, 4, 5, 6, and 7. It looks messy, but we grab our price range 2 right here. So you can see the price range 2. And then we can measure. Here, this point is the lowest one, and here's the highest one among these 7 points. So how we measure it, we just click this level and just look at the highest level. Okay, and we're done. And here shows the percentage change from the lower one to the higher one. Okay, so one of these wicks spiked aggressively, registering about 2.18% deviation. Because that exists over 1% threshold, we flag it as an algorithmic liquidity sweep and we throw it out. It is a noise. In other words, this point is a noise. And let's see the other 6 points. Let's measure the highest wick right here against the lowest wick right here of this group. And let's use this tool again. So we click it again and we start from this lower one to this higher one. Okay, so well, it's not perfect, but let's do it again. So from here to here. Okay, so it's about 0.95, 0.97%. Since it is under 1%, those 6 touches mathematically validate a brilliant resistance ceiling. So what we can do is that we can draw a horizontal line right here. Okay, so right here. And this zone is the resistance zone. Okay, and let's look at what happens next. The price finally breaks out above that ceiling from here and put back. So on this day, it puts back to right here and perfectly tests that exact same zone from above. Okay, the principle of polarity kicks in and our mathematically validated resistance ceiling cleanly flips into a massive support floor. In other words, this works perfectly as the support zone. Okay, and let's get back to the lecture. Now you might be asking, how does this 1% wick band combine with the dense real body zones we built in the last video? It depends entirely on the length of the wicks. If your stock has long, violent wicks, we use approach A. We treat this 1% wick band as its own isolated hard floor. We use it to snap entries and place tight stop losses, viewing the real body's future inward merely as a secondary confirmation area. If the wicks are short, we use approach B. We seamlessly merge the 1% wick band into the real body overlap, creating one think, unified execution zone where we scale in our capital evenly. Finally, remember to adjust for the assets beta. The 1% rule is the gold standard for standard mid to large cap equities. But if you are trading highly volatile cryptocurrencies, a 1% band is too restrictive. You must expand it to 2% or 3%. If you are trading slow-moving forex pairs, you tighten the band to 0.5%. And again, here is the illustrative example, and I have also copied the previous example right here. All right. Always adjust your math to match the asset volatility, and that's all for today's lecture. See you in the next one.